A $20,000 raise can leave you with less usable money. That sounds wrong until you stop treating salary as the answer and start treating it as the first line in a longer calculation. The Bureau of Economic Analysis built regional price parities, or RPPs, for exactly this problem. They measure how price levels differ across states and metro areas inside the United States. Same country, same dollars, very different buying power. The important part is what an RPP number means in plain English. The BEA uses 100 as the national average. If a place sits at 120, average prices there are about 20% above that baseline. If another place sits at 90, prices are about 10% below it. So when two employers wave around the same salary, or one waves a salary that is 20 grand higher, the headline figure still tells you almost nothing about the standard of living attached to it. And this is not some boutique index made from a few rents and a guess. BEA's RPP methodology pulls from Consumer Price Index price quotes across categories like food, transportation, medical care, education, recreation, and other goods and services, then combines that with American Community Survey rent data and BEA expenditure weights. Moving beyond subjective feelings about an offer requires a formal financial model. Offer A is the job you have now. Offer B pays $20,000 more, but it sits in another state, with another housing market, another tax regime, and very likely another pattern of daily costs. The right comparison is disposable income after the local system has taken its share. Three source backbones matter here. First, BEA RPPs for local price levels. Second, IRS rules for federal tax logic, because federal income tax is progressive and the bracket story gets mangled every time people talk about raises at a bar. A higher salary does not mean all of your income suddenly gets taxed at the top marginal rate. Only the income that falls into the higher bracket does. But a raise still increases total taxable income after deductions, so take-home pay rises by less than the gross number. Third, the MIT Living Wage Calculator matters because it forces the comparison back into household reality. It estimates what a given family type needs in a specific county or metro area to cover basics without public assistance, using local costs for housing, food, child care, transportation, health care, and other essentials. Same salary, different family structure, different county, different answer. A single worker with no children can absorb a move one way. A household with 2 kids and paid child care can get a completely different result from the same offer in the same city. That is where people usually make the mistake. They look at the raise, maybe glance at state income tax, and call it close enough. State tax does matter. Some states take a bigger bite from higher earnings, some do not levy wage income tax, and some lean harder on other taxes. On top of that, federal taxable income depends on deductions and the bracket structure set out by the IRS, so the path from gross salary to cash in your account is already narrower than the offer letter makes it look. But taxes are only the part everybody can see on paper before the move. The harder part sits outside payroll. Housing markets do not care that your recruiter said meaningful bump. Transportation changes when the new job adds distance, tolls, parking, or the need for an extra car. Childcare can move from manageable to brutal just by crossing a county line. The MIT framework treats childcare as a major category for a reason. For a household with children, it is not a side expense. It is one of the numbers that decides whether a raise is real or cosmetic in a given county. Companies understand this better than employees sometimes do. Corporate relocation policies often use cost of living allowances because employers know nominal salary can mislead. If equal pay always meant equal living standards, there would be no need to build those adjustments around housing, food, transportation, utilities, and related essentials. The existence of those policies is its own small confession from the labor market. A dollar earned in one region does not behave like a dollar earned in another. So the useful question is narrower and tougher. Offer B pays $20,000 more. After federal tax logic, after state and local burdens, after local prices, after the household-specific costs that MIT tracks, does that extra salary buy a better life or a thinner margin? Put differently, when identical incomes can support noticeably different standards of living depending on place, a raise is not a verdict. It is raw material for calculation, and the first number you need to distrust is the one in bold on the offer letter. This calculation begins with the portion of the raise that survives federal tax. For many middle-income households, that means several $1,000s are gone before the new city gets a turn. Then state tax rules step in. One state takes a direct cut from income. Another may skip income tax and hit harder through sales tax, property tax, or both. So the headline gain is already smaller than the offer letter suggests. And that happens before rent, gas, or daycare show up. Put rough numbers on it, and the shape becomes plain. This is a scenario, not a universal tax result. If that extra $20,000 is taxed at a 22% federal marginal rate, about $4,400 goes out at the federal layer. Add state income tax in a higher tax location, and the retained amount can fall further. Even without naming a single city, the point holds. A raise of $20,000 can quickly become something closer to the low or mid-teens in spendable dollars, depending on filing status, deductions, and jurisdiction. Housing costs further reduce this margin. Broad national comparison tables often place typical monthly housing costs somewhere around $1,800 to $2,800. And that spread alone is enough to do damage. A move from a cheaper market to a tighter one can add $700 a month to rent without doing anything exotic. That is $8,400 a year. Make it a $1,000 jump, and you are at $12,000. A big chunk of the after-tax raise is gone right there, in one line item, in 12 ordinary payments to a landlord or lender. Housing matters twice. It is usually the largest item in the household budget, and BEA data show that housing rents are often the main driver of regional price differences. That is why two places with the same grocery chain and the same streaming subscription can still produce very different financial outcomes. The zip code changes the expensive part of life first. In 2024, BEA's state-level regional price parities placed places like California, Hawaii, New Jersey, and the District of Columbia above the national price level, while states such as Arkansas, Mississippi, Iowa, and Oklahoma sat below it. Higher pay often arrives in higher cost territory. With average U.S. household costs around $6,500 a month, the pressure gets easier to hear. If housing is already the biggest piece of that monthly spend, even a moderate upgrade in local rent can shift the whole budget faster than people expect. Add $800 a month for housing, and you have raised annual survival cost by $9,600. If the tax-adjusted raise left you, say, $14,000 to $15,000, you have already burned through most of it. Transportation also adds new expenses. A longer commute is not just fuel. It can mean parking, tolls, more maintenance, faster vehicle replacement, or the need for a second car in a place where one used to be enough. Public systems can reduce some of that, but they can also replace car cost with fares, parking at stations, and time penalties that push other costs around the household. Transportation generally involves predictable expenses like fuel, insurance, maintenance, parking, and vehicle replacement. These expenses lack drama, but their stickiness drains budgets over time. Run a modest commuting change. Say the move adds $250 a month between fuel, parking, and wear. That is another $3,000 a year. If the new job effectively requires an additional vehicle, the math can get worse quickly. But even the mild version matters. Now the housing increase of $8,400 and the transport increase of $3,000 have absorbed $11,400 a year. Against an after-tax raise in the low or mid-teens, the margin is already thin. For families with children, childcare costs vary significantly by region. National estimates cited by Move.org put average infant care around $216 a week and care for a 4-year-old around $175 a week. Multiply those by 52 and you get roughly $11,232 a year for the infant and about $9,100 a year for the 4-year-old. Those are national averages, not promises for any given county, but they show the order of magnitude clearly enough. A local increase in child care pricing by a few $100s a month can erase what was left of the raise after tax and housing. This is why family profile changes the break-even point so violently. A single worker may absorb a pricier commute and smaller apartment and still come out ahead. A household paying for full-time care can get the opposite result from the same salary move. Child care costs have also risen much faster over the long run than many people's instincts allow. First 5 Years Fund, using Bureau of Labor Statistics CPI data, reports child care costs rising about 214% between 1990 and 2021, while average family income rose about 143% over that span. That gap matters when a family relocates into a tighter care market. There is also the cost of moving itself, and here the first year becomes a different calculation from the years after that. I cannot responsibly attach a single verified national figure for every move, because the total depends on distance, home size, timing, and local lease rules. But the categories are plain enough. Movers, truck rental, deposits, utility setup, application fees, temporary storage, and the ugly little overlap where the old place and the new place both need money in the same month. Current IRS treatment also matters. For non-military taxpayers, moving expense reimbursements are generally no longer excluded from income, so even help from the employer can increase taxable wages. That is the point where the spreadsheet has to split in two. Year 1 is one story. Steady state is another. In the first story, the raise gets hit by higher taxes, then by the recurring local budget, and then by the move itself, which is temporary but very real. In the second story, the move cost drops out, yet the new rent, commute, child care bill, and tax mix keep showing up every month. The long-run verdict is cleaner. A household should judge the offer on steady-state disposable income adjusted for local price levels, because that is where wealth is either built or quietly bled away. The caveat matters too. Purchasing power is often approximated by adjusting income for local prices, but there is no universal rule that one simple division settles every case. Different cost structures and household mixes can bend the answer. Still, the decision rule itself is plain. A $20,000 raise makes you poorer the moment the new zip code costs more than the after-tax raise, plus any verified employer support. If the raise nets, say, roughly the mid-teens after federal and state effects in one household model, and the destination asks for $21,000 more a year to maintain the same standard of living, the household is behind by thousands. The inverse case is the one people resist because it offends the headline number. Under one scenario, not data for every move, a $20,000 pay cut can improve financial position if the cheaper market reduces the full annual budget by more than $20,000 and the local price structure is materially lower. Treated strictly as a scenario, this shift can beat a nominal raise into a premium cost area. Not because lower pay is magic, because disposable income is the number that buys the life. There are limits to what the math can settle on its own. Benefits quality can swing the result. A richer health plan, pension match, equity grant, or bonus structure may offset an immediate budget loss. Dual-income households can also break the model in either direction if one spouse gains or loses earnings after the move. School district quality may justify a more expensive area for one family and be irrelevant to another. Promotion velocity matters too. A role that is slightly worse on year one cash flow can still be rational if it changes the next 5 years of earnings. So if the math shows the raise is a loss, is the higher paying job ever worth taking? Yes, if the long-term trajectory, equity prospects, or benefits outweigh the mathematical deficit of the first few years. But that answer only works after the deficit is named honestly and counted in dollars. The clean way to end it is also the least glamorous one. Income has to be measured in purchasing power and disposable terms, using the household budget categories that actually recur and the local price differences the BEA is trying to capture. A bigger salary is just a louder number on paper.